Hello, everyone. This is Mitch. We are getting ready. Okay. Welcome to the live stream. This is my live stream. I call it Be the Boss of Your Money. Just wanted to come up with an idea for the name of a podcast / live stream. And boss, money boss, those words, that seems like such a good combination. So I went with Be the Boss of Your Money. So thank you very much for joining me. I've got a couple of things to talk about. Yeah, the usual market update, but I always add a lot of perspective. So it's not just your usual market update. And I want to thank everyone for joining me. And I'm using this week to do some reflecting, and we've got all kinds of things going on like everybody else. And I want to make sure that, I want to make sure for me personally in life that I don't just run through the day-to-day routine and too much and just let a lot of time go by without giving some very deep, thoughtful consideration to how I want my life to be, to how I want to, at least shape the life that I'm providing for my children until they are, of course, old enough to provide a life of their own. And I want to make sure that, my wife and I are in agreement, of course, on any changes we make. So I just don't want to go through life meandering. And I use this time of year for a lot of introspective, deep thought. And I want to I don't know if you're like that. I get very philosophical this time of year. I imagine a lot of people do. So I want to talk to you about stimulus stocks in 2021. It's an important topic. We're going to cover a couple of things. We have some really good things to check on. So what I'm going to first do is I'm going to show you the most important headline that you're going to see at the end of the year. I'm telling you that I have a headline that I'm pulling straight off of CNBC. I'm going to put it on the screen. We'll talk about it. We're only going to talk about that for a second because I think the headline says it all. All right. But we're going to get into stock stimulus next year, what I expect. And it's good. I'm telling you, watch this show. And I think we could wrap it up in like 20 minutes. We're already on for 2.5 minutes. So here's the quick intro. And then I'm coming back and we're just diving. We're diving right in. Here we go. Well, hello there. My name is Mitch Goldberg. If you're just joining us, we're talking stocks, we're talking stimulus, we're talking 2021. I've got the most important headline for you to end the year. And you ever see something that just validates a lot of things that you're thinking? And I found one, and I think it's significant. And we were talking how, by the way, I see a few people out there in Facebook land and LinkedIn land. And I know Michael is out there. Folks, if you have any questions, words of wisdom, words of encouragement, those are always appreciated. Comments below. Hit the comments. Ask me your question. Say hello. That would be a lot of fun. I love the interaction. Who's out there? It is none other than Ryan Stark of MCO Advisors. It's the deep end. Yes, we are definitely in the deep end of the pool, my friend. So we're talking about stocks 2021, a significant headline. Okay, so first of all, I just want to start by talking about tax loss selling and changes for 2021. I'm not a CPA. If you have any questions, I'm not an accountant. If you have any questions about that stuff, speak with your tax advisor. Just have to get that out there. Oh my God. Dan is out there. Dan, great to see you today. Dan is a banker at a very major bank. And Dan is a great guy. And thank you for all your help. And Jay is out there. Happy holidays to you as well, Jay. I really appreciate that. I love your new profile pic on your on Facebook. That is awesome. And so good to see you, my friend. Folks, you have any questions, words of wisdom, and encouragement? Hit me up. Insults, those are okay. I guess an insult is better than no comment. According to the algorithm, anything is better than nothing. So, insults, critique, criticism. Yeah, you could hit me up with all that stuff. Hey, Phil, great to see you. Thank you so much. You are such a good guy, Phil. It's just I'm lucky to have you in my life. Thank you. You're welcome, Jay Spinney. Jay is he's the biggest hedge fund manager I know. That's because he's like 6 foot mid range and he's just a giant of a human being. But he's got a giant heart and a giant soul and just a giant kindness and intelligence about him. Thank you, buddy. So let's talk about real quick the first thing that I want to just get this out of the way. The most important headline, just a real validation. We're going to just show you right now. It's good stuff. Okay. JP Morgan. Ta-da, ta-da, the big headline. JP Morgan bets big on post-pandemic travel boom with credit card rewards acquisition. Post-pandemic travel boom. Could you just think of that for a second? Now, almost knocked the wire out of the computer. My prediction, my baseline for 2021 is that we muddle through the pandemic. We start coming out of it. The economy starts to heat up, late first half, early second half next year. And I'm talking about a significant pickup in the economy, like people just going out, experiences are back, going to, traveling, concerts, people getting together. We are the experience economy, a lot of people say, right? So that is so symbolic of what I think is going to happen. And just, it's one thing for me to say it, though. It's another thing for a giant like JP Morgan to actually bet real money on it. Because if you said, hey, we should bet on travel and airlines and cruising and hotels. Well, this is a credit card rewards acquisition, but you use credit cards to pay for everything. So that's what okay. By the way, headline just pops up. U.S. confirms first case of the new COVID strain that was discovered in UK. All right. Well, that's not going to really change the equation here, but that's pretty significant that JP Morgan is betting on this as well. So if you feel like you should be betting on economically sensitive stocks in a recovery, you have really good company. Okay. So just want to give a quick shout out. Bill, good to see you. Thank you so much for joining me. You were just been a terrific supporter. Thank you so much. And Nick Nielsen is out there. By the way, Nick Nielsen, you see that Nick Nielsen CFP, he's on LinkedIn. Follow him. He puts out these incredible illustrations to make points about personal finance. And it's just some of the best content that you could see. It's just an illustrative financial education. Okay. So my base case is we have this surge sometime it'll be a really good second half next year. The stimulus now helps a little bit. We'll probably get more stimulus. If it's not direct checks, $2,000 for everybody or more money, it'll be, some kind of infrastructure. There's going to be more stimulus though. All right. I think the stars are aligned in that. We can all agree on that. Is it so much economic activity that it pushes the Fed to raise rates? That's like the $64 trillion that is the $64 trillion question. And if we do get a spike in the second half, which I think we will, is it just to make up for pent up demand and then the spike goes away and we get back to like a lower but new normal trend? That's the question that everybody's going to start asking in the next couple of weeks. You're going to start hearing about that in the media, financial media. It's like, are we at trend now? Or is this like, we're not going to have a blistering economy forever. So we get the quick bump up and then I guess what we do is we get a very strong economic recovery. We slow down into an economic expansion. That's the way the cycle works. Let's take a quick look at a couple of things. But first, the experience economy. The experience economy is defined by a couple of things. It's baby boomers who are retiring, who want to scale down the size of their house, and they just want a place to sleep. Then they shut the door and they go and travel. They cruise, they fly, they visit people, they get together with friends. They do a lot of activities outside the house. And that is also very important to everyone else, to the millennials, to the Gen Z. Nobody ever talks about Gen X. I'm a Gen Xer, and nobody talks about Gen X. There's only like 40 million of us. So we're kind of sandwiched between like 87 million boomers and 90 million millennials. Okay. I'm in between. So I get you both. Okay. But I think that's the experience economy really sees a big rebound. We've seen everybody buy stuff, a lot of stuff for their houses, a lot of goods, but now we get back to experiences. My 2 cents. Let's take a quick look at the markets, how we did. We hit a new record during the day earlier today, but then the everything kind of just petered out. The market has a very tired feel. I wouldn't call today a disastrous day. It was just a ho-hum down day. It was up. Democrats are pushing another $1,400 stimulus checks. It was shot down in the Senate by McConnell. So we'll just have to wait, a few months. It won't have nothing January, maybe February, March. We'll see what happens. Okay. But, once we start getting through the COVID, the weather gets warmer. Not to say that warm weather makes the virus go away. Please don't give me some lip about that. All I'm saying is that people could spread out a little bit more, and you don't have people in as close quarters as you did before. And then we have the vaccines and therapeutics going around, and we'll have even more of this stuff early next year. So all I'm saying is today was just a ho-hum day. It just a little bit of a tired feeling to the market. We're still right near record territory. I don't think too many people have anything to complain about. The loser of the day was the Russell 2000. That's small cap stocks. They would have benefited the most from stimulus because small cap stocks get most of their money revenues domestically, so they are more sensitive to the U.S. economy. The VIX was up a little bit today, up 6%. I know you're saying that's not a little bit, but that's common for the VIX to have 5% plus moves up and down. But it's up to 23, getting close to that 25 level. Let's take a look at the FANG M stocks. Let's FANG M stocks first. Okay, that's Facebook, Amazon, Alphabet, Netflix, Google, Microsoft. Let's take a look at how they did. Mixed bag. They were up nicely yesterday, just a mixed bag, but Netflix had a decent day. They are chilling. Oh my God, did I just say that on live stream? Amazon up 1%, but Facebook off a teeny tiny bit after a good rebound yesterday. Microsoft off a teeny bit. Apple off a little bit. Apple just had a nice move though from about 114 to 134. So, can't go up every single day. So that is perfectly acceptable. Folks, if you're watching this in the replay, by the way, I want to thank you as well for joining me, and your time is valuable. And it means a lot to me that you chose to spend of it, and it means a lot to me that you chose to spend some of it with me right now. So thank you. And I see Stacy is out there as well. Thank you, Stacy. You've always been so supportive and a viewer, and I really appreciate it. I really do. It means a lot to me. And so let's just take a look at one more thing. Winners of the day: healthcare, consumer discretionary. Consumer discretionary is like travel, cruising, airlines. That's kind of what the JP Morgan thing was about. That headline I showed you before, that they're betting on a rebound in travel. Losers of the day: real estate, energy, industrials, even technology. Mixed bag today, mostly a down day. But again, the worst ETF that represents a major sector was real estate, down 0.77%. Not like I said, not a disastrous day. Let's talk quick about 2021. Then I'm going to hightail it out of here. I'm going to hightail it out. Did I just say that I'm going to hightail it out of here? Where does that come from? Is that like a Bugs Bunny cartoon? So for 2021, stimulus and stocks. Stimulus is going to help. It's not enough, but the moratorium on evictions, the extra unemployment, $300 a week. Some people will get a little bit more. These things will help us bridge the gap until we finally get to next spring. And we'll probably see a little bit more in terms of stimulus accommodation from the Fed. Federal Reserve has said that they won't raise rates even if inflation does hit their magical 2% target, that they still don't want to raise rates. I think the betting is that inflation is going to remain dormant for at least the next 5 years. That's a hell of a bet. I don't know how you predict something in in 5 years. I really, it's so many things can happen in 6 months, let alone the next 5 years. 6 months is a long time, and 5 years is an eternity. So that's really all I have for you today. That's the show. All right, I told you today was going to be brief. So I want to thank you for joining me. I'll probably be back tomorrow and Thursday. I do want to have like a wrap up for the year, some good stuff. Thank you so much. If you have any questions, anything, wait, hold on. Happy holidays for Nick. Nick has a question. Thoughts on developed international with the weak dollar? Okay, I think it's negative for developed international. Weak dollar is good for us, bad for them, and a weak dollar favors large cap exporters. Like it favors a Boeing, it favors large cap semiconductor type companies. It is overall net good, but it is a little bit on the it could be a little bit stimulative for inflation. We have to see how long the trend lasts, but generally speaking, European markets have been valued lower than American markets, stock markets, for the better part of a decade now, maybe more, at least since the Great Recession. They never really came out of the Great Recession like we did, not with their markets either. So I don't think it's a huge deal. And as far as what we preach, diversification, which is a strategy that we use that doesn't necessarily protect you from a generally down market, but it is a way that we mitigate risk, basically. I just have to get that in there. So for diversification purposes, I wouldn't avoid international investing. Neither would you. I know that. I don't think you would, but I shouldn't say that. I don't know what people do, but I can only say what I do. So I wouldn't avoid international investing because of a weaker or stronger dollar. We're not making macro bets like saying, hey, let's go all in for a strong dollar, a weaker euro, and play that. It's not really something that most people have the ability to do. And sometimes they're wrong, and it could result in some pretty substantial losses and missed opportunity as well. So just keep investing every month to diversify, be exposed to more than just tech stocks, and make sure that when you have a goal coming up, that you are preparing for it by moving your needed money for a commitment to cash well in advance. Lynette, thank you. Great to see you. Right back at you. Okay. And that's it. I'm signing off. Speak to you soon.